When you're getting a mortgage, the rate matters. We know that. But I want you to understand there's a difference, I think, between how a rate feels as far as changes in the actual rate versus how it translates into the payment. So the thing to keep in mind is, although it might psychologically feel significant to change a quarter in rate, what really matters is how your payment's impacted. So there are two main factors that drive your payment: your loan amount and your interest rate. The thing to keep in mind with the change in loan amount is about every $10,000 change in loan amount is around $50 a month in payment. To explain that on a larger scale, $100,000 at 2.75 is going to have a monthly payment of $408. At $200,000, that goes up to $816, and at $300,000 is $1225. So now that we know the difference between the changes in loan amounts, let's talk about the changes in rates. At $100,000 at 2.75, the payment is $408. If the rate goes up to 3%, then the payment increases to $422. And then if it increases by 0.25% in rate again, the payment is $435. So it absolutely feels significant to go from 2.75 to 3.25. And yes, that does impact the payment and the interest that you pay over time. However, when you look in the difference in the payment, going from $408 to $435 is not as significant on your budget. The other important thing to keep in mind is that you can lock your rate once you're under contract, and typically once you're in about 60 days from closing. We work hard to offer our clients competitive rates, and I understand how important it is to get the best terms possible. The thing I want you to understand is the rate environment isn't something that we can control. So while you have other things to focus on, let me worry about your rate structure and give you advice on what the best strategy is to not just serve you now, but also for your long-term financial plans.